Hello there, welcome to this guide on how to create a profitable Forex trading strategy. I'm going to lead you by the hand and teach you the steps you need to make in order to create your very own trading strategy. It is January 2024, it is the 19th of January. Things have been very mediocre. I have been very active. I'm looking at my brokerage accounts now. I've been very active. I've been taking trades most days, including my open positions though. I'm kind of break even. My performance is not really going anywhere. I'm always keen to build profits early on in the year to have a cushion to work with for potential losses as the year goes on. Obviously, I have very little control over that. You get what you're given. But around break even, hoping that things pick up soon. I hope the market's treating you better and money's coming in. If not, watch this video because I'll teach you how to create a trading strategy that's going to make you money in the Forex market. So let's just jump right in and get started. What is a trading strategy? Sometimes it's called a trading plan, trading system. Sometimes it's just referred to as trading rules. A trading strategy is all those things. What it is, it's a set of rules that you create in order to give you a trading edge. So it's a set of rules that you'll follow to help you know when to take trades, when not to take trades, what to look for. And if you follow these rules, chance should be in your favor and you should make money from the Forex market. It's a map, it's a guideline that a trader follows to give them an edge. So why do we need trading strategies? If you don't have a trading strategy, you're simply left to your own devices, i.e. you're going to trade your emotions. A more sophisticated way, and quite a deceitful way of putting that, is you're left to your own discretion. Some people say, oh, I'm a discretionary trader. I trade my own discretion. There's no such thing. There's no profitable thing as trading with discretion. You may have some traders out there that use an element of discretion as part of a trading strategy. There's no such thing as 100% discretionary trading. Because if you don't have a plan in place, you're simply trading your emotions, or at least are very vulnerable to trading your emotions. And this is why we need a trading strategy, because it cuts out the emotion, it makes us consistent in what we're doing, and that's the key to making money from Forex, is having a edge that is consistent. So a trading strategy, a trading plan, a set of rules, a trading system gives us an edge to make money from the Forex markets, and it's not possible to make money long term without some sort of consistent approach to trading. That's why we need a trading strategy. So how do we create a trading strategy? Well, that's what I'm going to cover in this video, is how a trading strategy is created. You really have two options when it comes to trading strategies. You can develop your own trading strategy, which I'm going to show you to do in this video, or you can learn someone else's, or at least adapt someone else's, modify someone else's. So there are plenty of courses, forums, and things like that online that will teach you trading strategies. Worth looking at to get some ideas, but they're really your two options, is to learn a trading strategy or develop your own, and this video will cover that second option, developing your own Forex trading strategy. If you want to learn someone else's, just check out my website. Okay, so I've broken this down into 5 easy steps for you. 5 simple steps. 5 steps to creating your very own trading strategy. And step 1 is deciding the basis of your strategy. i.e., Is it going to be a day trading strategy or a swing trading strategy? If you're new to trading, if you're new to Forex, I highly encourage you, forcefully encourage you to choose that latter option. Day trading is really for a very minute amount of traders, and generally those traders are very experienced when it comes to Forex or trading in general. Swing trading is where you want to start. And most of you have jobs or are students or have other commitments, your parents full-time. So swing trading generally fits people's lifestyles more than day trading anyway. You also need to decide if the strategy is going to be based on technical analysis and including price action indicators in technical analysis, if it's going to be fundamental analysis or both. Once again, I strongly encourage, I exhort you to use that latter option. Use both fundamental analysis and technical analysis. I've been trading for 12, 13 years now, and I can tell you the most successful way, the most profitable way to trade any financial market is combining fundamental analysis and technical analysis. Now, some of you might not like that advice because you like technical analysis. I love technical analysis too, but you've probably realized by now you're not getting a sufficient edge to make money. Fundamental analysis will also help you overcome trading emotions because fundamental analysis can provide much greater confidence in trades than technical analysis can. Fundamental analysis makes much more sense. So try and use both. But some strategies are purely technical and some are purely fundamental. If you are looking at technical analysis, there's so much to consider. Things like patterns, reversal patterns like inverted head and shoulder patterns, double tops, continuation patterns, price action setups, pin bars, engulfing candles, channels, that's trend channels, bullish, bearish, horizontal, sideways channels, support and resistance. That is a huge thing by itself. We could look at trend support and resistance. We could look at support and resistance against a trend or support and resistance that supports a trend. Horizontal support and resistance from higher time frames and trading that on lower time frames. So that's this huge area within itself. Divergence, moving averages, things like moving average crossovers, dynamic support and resistance provided by moving averages, consolidation breakouts, all sorts of indicators, etc., etc. With fundamental analysis, it's usually things like interest rates, forecasting interest rates, trading interest rate decisions, inflation, forecasting inflation, how that influences interest rates, economic figures, economic events, etc., etc. Now, a couple of things I'll mention to you about this list and things that I've said so far. How do you know which to focus on? You know, I'm not suggesting that if you create a trading strategy that is technical based, that you're going to use everything I've just listed. That would be crazy. You'll be looking at far too much and your charts will look like a kid scribbled all over it. You know, a 3-year-old's drawing. It will be very scribbly, be very hard to read. It'll be too much information. What you need to do is kind of pick the areas that, 1, make most sense to you, 2, you enjoy, and 3, are easy for you to spot. And all three of those things kind of go hand in hand, because generally the things that are easier are the things you're going to enjoy more and are easier for you to identify in the markets. So it could be that you've grown a love for price patterns, or horizontal support and resistance, or consolidation breakouts. If you have naturally kind of bonded with one of these technical analysis specifics, that's what I suggest you start basing your trading strategy around. Something else I'll mention. If there is something here, such as fundamental analysis, that scares you, you might be thinking to yourself, well, my strategy is going to be purely technical because I don't understand fundamental analysis. Please learn fundamental analysis. If you've never heard of divergence, please look at it. It's important to explore all the options before deciding what you're going to start trading. I mentioned creating a trading strategy around something that you love and find easy. If you've only ever learned price action, obviously you're going to choose something price action related. That's not what I'm suggesting. I'm suggesting you kind of learn everything and then hone in on a couple of things. Okay, so I've learned all these things over the years, and I only really use a third or half of the things listed on this page. So step 1, decide the basis of your strategy. So for example, someone could be watching this and think, I'm going to create a swing trading strategy based on trends caused by interest rates, and I'm going to be looking for dynamic support and resistance. Something like that. Or I'm really keen on horizontal support and resistance from higher time frames, so I'm going to be looking for divergence around those levels. It can be as simple as that to start off with, and we'll build on that as this video goes on. So step 1. If you have any questions, use the comment section below. Whilst I'm mentioning the comment section below, let's have a bit of a competition. I do have a Ultimate Forex course that teaches lots and lots of things about Forex, including my very own profitable trading strategies. If you would like exclusive access to that course, if you want to win exclusive access to that course, then do 2 things. Comment below and tell me what you like about technical analysis or fundamental analysis. It could just be, I love channels, I like support and resistance, or I'm going to create a strategy around moving averages. Leave a comment section below, like the video, and then drop me an email. Samuel, Samuel, at love-the-pips.com. You'll find my email address on my website, actualforextrading.com. I'm not trying to sell anything, I'm trying to give something away. Leave it in the comment section below, like the video, drop me an email, and I'll pick someone in the next few weeks and give you free access to my course. Okay, step 2, KISS. That's an acronym for Keep It Simple, Stupid. So keep it simple, stupid. KISS. So a trading strategy should be simple. As simple as you can make it, but not too simple. Now, what do I mean by that? Let's say you've learned about engulfing candles and you start trading engulfing candles. Engulfing candles are not going to make you money by themselves, nor is anything from this list. You may have just learned about divergence. Divergence by itself is not going to make you money. You might have a good trade or 2 short term, but long term you're going to fail and you'll become emotional and you'll blow your trading account. So how do we keep it simple yet make it complex enough to give ourselves an edge? It's all about layering. Okay, so when it comes to trading and creating a trading plan, you need to kind of combine at least 2 or 3 elements, at least 2 or 3 forms of analysis together to give yourself an edge. So it could be that you like divergence, but you're going to have to combine divergence on the 1 hour time frame based on weekly support and resistance, and have some sort of indicator as a confirmation. So you need to layer these things up, and you need at least 2 or 3 layers. As an example, my main trading strategies these days are based on some sort of fundamental analysis with a higher time frame support and resistance, some sort of price action pattern or indicator on a lower time frame, followed by a setup. So there's like these 4 layers. 1, 2, 3, 4. Okay, so it needs to be simple enough for you to follow, but complex enough to provide an edge. And complex probably isn't the right word. Sophisticated is probably a better word. It needs to be sophisticated enough to provide an edge. Now, to help you really simplify your trading strategy, focus on 3 areas. So there should be 3 main parts of your trading strategy. The analysis and criteria to forecast currency direction. So am I looking to buy or sell? The analysis and criteria for entry. So where and when am I going to enter a trade? And then the same for exit. So they're the 3 main areas you need to focus on for creating a simple trading strategy: direction, entry, and exit. Okay. Once again, any questions or comments, use the comment section below. Step 3, detail. Now, this may sound very contradictory to the previous step. I just told you to keep it simple. Now I'm telling you to be detailed. I'm not telling you or teaching you that a trading strategy should be too complex for you to follow. What I'm trying to teach you is a trading strategy should be detailed enough so all bases are covered. Because if all bases are not covered, then there is this room for trading discretion, i.e. trading your emotions. If there is part of your trading strategy that is emotionally led, believe me, trust me, you'll start losing money. It's that simple. So what do I mean by all bases are kept? Well, the first 3 bases are these: direction, entry, exit. There's no point in having a trading strategy that just covers entry and exit. You need some way to gauge direction. If there isn't, you're just going to base the direction on your own emotions. And the same if you have direction and entry but nothing for exit, you're going to base the exit on your emotions. That is not going to provide consistency. But there are so many other areas that you need to detail, that you need to think about and write a trading plan for, not just direction, entry and exit. Which pairs to trade? Which time frames are you going to trade? If you don't have these things listed, you'll start becoming emotional. It might be amazing to have this great trading strategy, but what pairs are you going to trade? Someone might apply the strategy to just Euro US dollar, whereas someone else is going to apply it to Euro yen. Someone else is going to trade against 15 currency pairs, and the results are going to be completely different for each person because there's this emotionally led choice. Same with time frames. The time of day, I know what time I start each day, what time I end each day. This provides consistency and is needed for backtesting. Stop loss placement. I'm talking so much, my throat's getting a bit sore. Stop loss placement. Where's the stop loss going to be? Where's the take profit going to be? When am I going to adjust my stop loss, if ever? When or do I need to adjust my take profit? What would be the criteria of adjusting that take profit? How much am I going to risk per trade? What do I do if I have open positions during major scheduled news? What do I do if I have a signal to enter a trade just before major scheduled news or just after? Spread widening. If I'm holding positions and there is a holiday coming, the Christmas holidays, or market close is approaching, what do I do about spread widening? What do I do if I miss a trade? Do I just ignore it and carry on? Do I just enter late? What do you do? What do you do? What do you do? What do you do? You need to cover as many bases as possible. Once again, keep it simple. You know, how much to risk per trade? 0.5%. Simple enough. So you need to keep it simple, but you do need to cover everything, so there's no room for trading emotion. Step 4. The Holy Grail. Only I have the Holy Grail. Not really. Step 4. There's no such thing as the Holy Grail, and most of you listening will know that. You've heard this time and time again. There's no Holy Grail when it comes to trading strategies. There's no trading strategy that's going to have a win rate of 95% and provide 3,000% return per year. Most of you know that, but you don't really know that, because most of you have wrong expectations when it comes to a trading strategy. For example, I have received countless emails over the years saying all I want is a trading strategy that's going to give me $300 a day. There's no such thing. Trading performance is not that consistent. Trading strategy should be consistent, but the performance, the results are not going to be that consistent. If you're expecting to make $300 a day, you're in the wrong business. It's better to go and set up a business perhaps, or be a freelancer, because no trading strategy is going to do that for you. Even if it's a day trading strategy, you're going to have losing days, losing weeks, losing months. Your expectations need to change. Expect a win rate between 50 and 70%, and expect to make anywhere from 20% to 100% per year return. So it's possible to double your account every year. It's not possible to double your account every month. Anyone that is teaching that is wrong, and they need to prove that they can do that. So you might need to change your expectations. The more realistic your expectations are, the more chance you're going to stick with your trading strategy and make this a success. Talking about win rates, I have a great slide. It's not a slide, it's a table on my website. Let me bring it up at the end for you, if I remember. Step 5, last step. So once you have everything detailed, you know what the basis is, you've covered how to enter, how to analyze market direction, things like that, the risk, etc., etc. Step 5 is to back test the trading strategy. I suggest you back test at least 2 years of data. And once you've done that, as long as the results are positive and you're happy with the win rate and things like that, you can then live test that on a demo or a small live account. But it's important to get some sort of real-time practice with the strategy, and then hopefully you're good to go. When you back test, it could be that the results are poor, it could be that the results are negative, and that your trading strategy does not provide an edge. If it doesn't, then you need to change some things about the trading strategy. In extreme examples, you might have to completely rub off the strategy and start with something new. Start with a whole new concept. But most of the time, you can just tweak certain things, perhaps add another layer, change the time frame, reduce the amount of pairs you're watching, etc., to tweak the things so you start seeing results. Okay, that's the end. Now I mentioned a table. Let me bring it up. Will it show if I drag it across? There we go. So this is step 4. This is on my website. There's so much more content on my website than there is on these videos. So find this page. There's the URL at the top there. But if you go down to step 4, which is here, this is a very interesting table that will show you the probability of X amount of consecutive losing trades every 100 trades and your win rate. So if you have a win rate of say 60%, you're highly likely to have 2, 3, 4 losing trades in a row. A lot of people don't expect that to happen. But most people's win rate is going to be around 50%. So half the time, 51% of the time, or there's a 51% chance, this is a better way of putting it, a 51% chance of having 6 losing trades in a row. This is a bit of a wake-up call to some people. But if you expect these things, if your expectations are realistic, then it's not such a shock when you have 6 losing trades in a row, and you're more likely to stick with your strategy. And if you stick with your strategy long term, you'll start making money. Believe me, as long as the strategy is profitable, as long as you've gone through the steps, you've back tested, etc. Okay, thank you so much for watching. Another reminder about the competition. Leave something in the section below, the comment section below. Let me know what you love about trading, what you plan to use as part of your trading strategies, or what you already use as part of your trading strategies. Like the video, send me an email, and you might win access to my course. Thank you so much, and I'll speak to you again in another video.